Well, there's been a lot of talk lately about silver possibly running to $300, maybe even $500 before the summer heat is even fully priced into the market. So in this video, we're going to separate the signal from the excitement, and you are going to walk away feeling a lot smarter, a lot calmer, and a lot harder to shake out of your position. Today on New York time, it is Saturday, May 9th. Comment below what day and date you're watching from. And if you value this kind of breakdown, support the channel by subscribing and commenting John AG. That tells me you're here for the work. So, in case you haven't heard the big claim floating around, it goes something like this. Silver has already shown leadership. Gold still matters. Gold is still the big monetary anchor. But silver, and especially the companies tied to silver, may now be the place where the bigger percentage move shows up. And on the surface, I understand why that gets people excited. When silver is sitting around the low 80s and someone says it could go into the hundreds, your brain immediately does the math. It sounds explosive. It sounds life-changing. It also sounds a little crazy, right? So the question is not, can someone make a bold forecast? Anybody can do that. The question is, does the market structure actually support even part of that idea? Let's take it apart piece by piece. First, silver has not been moving like a quiet little industrial metal anymore. Based on recently published market numbers, silver is still nowhere near those huge forecast targets, but it is also no longer acting like the forgotten metal it was for years. It has been trading around the low 80s, while gold has been holding in the high 4,000s. That means the market is already telling us something important. Gold may be the heavyweight, but silver is where the volatility is. And volatility cuts both ways. This is where a lot of investors get confused. They see silver spike, then collapse, then recover, and they think, okay, the thesis is broken. But that's not always how a major repricing works. Sometimes the market doesn't walk from old price levels to new price levels. Sometimes it stumbles, runs, gets shoved backward, and then suddenly everyone realizes the old map is useless. Now, does that automatically mean silver is going to $500? No. And honestly, that's the first place we need to be careful. A target like that is not a fact. It's not a current price. It's not confirmed destiny. It is a forecast, a very aggressive forecast. An aggressive forecast should be treated like a flare in the sky, not a GPS route. But there is still a serious argument underneath it. The basic argument is that silver may be entering a different valuation zone because the old financial world is under pressure from too many directions at once. Stocks are expensive. Bonds are no longer behaving like the simple, safe place people were trained to believe in. The dollar still works day to day, obviously, but its purchasing power has been stretched by years of deficit spending, stimulus, and rising debt. And when people start questioning the foundation, they usually go looking for something that cannot be printed with a meeting and a press release. That is where gold and silver enter the story. However, there's a trap here. A lot of people want to explain every move in metals with one headline. War headline, buy gold. Peace headline, sell gold. Oil jumps, silver must fall. Stocks rally, metals must be dead. That kind of thinking sounds clean, but markets are rarely that clean. For example, recent market updates show oil is still elevated, treasury yields are still in the mid-4s, and stocks just pushed to fresh record territory. That sounds like a strange combination, doesn't it? Expensive stocks, high debt, firm yields, strong gold, strong silver, and nervous energy markets all at the same time. So if someone tells you there is one simple reason for everything, be careful. The real answer is usually a pile of pressures, not a single button being pushed. Now let's talk about the silver drop that scared people. Silver ran hard, then pulled back hard. And if you only look at the highest tick and the lowest tick, it can look like a disaster. But here's the thing. Not every high is equally meaningful. If a market only touches a level briefly and then immediately rejects it, that level can be more of an emotional print than a stable price zone. It matters, but it may not define the whole trend. Think of it like a crowded auction. Somebody screams a wild bid, the room reacts, then the real bidding resumes lower. That doesn't mean the item is worthless. It means the first bid was too fast for the room to digest. Silver did something like that. It overheated. It dumped. It shook out weak hands. Then it recovered enough to make the bears uncomfortable. And that last part matters. If a market breaks down and stays broken, that is one thing. If it breaks down, traps people, and then climbs back into the range, that is a very different message. So here's the better question. Is silver quietly repairing, or is it simply bouncing before another leg lower? My answer is this. Both sides have evidence, but the bears need silver to fail quickly. If silver keeps holding the low 80s, then pushes toward the next psychological zone above it, a lot of traders who called the move dead will have to rethink. And when traders rethink at the same time, price can move faster than people expect. But again, don't confuse possible with guaranteed. The stock market is the next piece. The bearish argument says stocks are in a topping process. Not necessarily crashing tomorrow, not necessarily falling apart in one dramatic week, just topping. And that distinction is important. People hear the word top and they imagine a cliff, but major tops often look more like a ceiling being tested over and over. You get rallies, you get new highs, you get headlines saying everything is fine. Then, underneath the surface, leadership narrows, valuations stretch, credit gets tighter, and the market becomes more dependent on fewer names carrying the whole index. That is why the latest record in the S&P matters, but it does not settle the debate. Yes, stocks are strong. Yes, buyers are still showing up. Yes, the artificial intelligence trade and large technology earnings have been supporting confidence. But a record high by itself does not prove risk has disappeared. Sometimes record highs are confirmation of strength. Sometimes they are the final stage of confidence before the crowd realizes the floor is not as thick as it looked. So I would not say stocks must crash right now. That is too simple. I would say stocks are strong, but the reward for chasing them is becoming more selective. And that leads us to bonds. This is probably the most important part of the whole story. The old retirement model was simple. Own stocks for growth, own bonds for safety. But what happens when bonds stop feeling safe? What happens when government debt is near $39 trillion, Treasury borrowing needs keep rolling forward, and yields remain high enough to make refinancing painful? That does not mean a bond crisis is guaranteed tomorrow. Let's be precise. The Treasury market is still deep. It still functions. It is still the center of global collateral. But the pressure is building, and even major financial leaders have been warning that the bond market deserves more respect than it is getting. And here is where I disagree with the most dramatic version of the silver argument. Some people say the Federal Reserve is already printing in a crisis mode. I think that is too loose. According to the latest publicly available policy updates, recent asset purchases have been described as reserve management, not emergency rescue. That distinction matters. Maintaining banking reserves is not the same as launching a panic-era stimulus program. However, and this is the key, markets do not wait until the language becomes obvious. If investors start believing that more liquidity will be needed later, they may begin positioning before the official explanation changes. That is why gold and silver can move before the policy panic is visible on television. So, the bullish metals case is not just the Fed will print. It is more subtle than that. It is that the system may be moving back toward a world where liquidity has to expand, debt has to be absorbed, and investors begin asking whether paper promises are enough. Now let's bring crypto into this. Bitcoin has been trading around the low 80s after a much larger run and a much larger setback. Some people still see it as digital gold. Others see it as a risk asset that rises when liquidity is easy and suffers when confidence tightens. I think the truth is somewhere in the middle. Bitcoin has a scarcity narrative, but it also trades with a lot of speculative behavior. So if stocks wobble and liquidity expectations shift, crypto may not automatically protect people the way gold has historically been expected to. That doesn't mean Bitcoin goes to zero. That's cartoon analysis. But it does mean the crypto replaces metals argument is not as clean as it sounded a few years ago. When real stress hits, people still look at what has survived centuries, not just what performed well in one liquidity cycle. Now, silver miners are another layer entirely. If silver rises, miners can outperform. That part makes sense. But miners are not silver bars. They have management risk, cost risk, jurisdiction risk, energy risk, financing risk, and sometimes dilution risk. So when people say miners will explode, maybe. But the best miners and the weakest miners are not the same thing. A rising silver price can lift the sector, but it does not fix every bad balance sheet. This is where investors have to slow down. If you're successful, share your success story in the comments so others can stay motivated. Because the goal is not to get lucky once. The goal is to make decisions you can survive emotionally and financially. Now, commodities as a group also deserve attention. From recent market updates, broad commodity benchmarks have been much stronger over the past year, helped by energy, metals, and supply constraints. That supports the idea that this is not only a gold and silver story, it may be a real asset story. And that matters because when paper assets get crowded, real assets can quietly become the alternative. Oil, copper, grains, uranium, silver, gold, and related producers do not all move together every day, but they share one thing. They are connected to the physical world. You cannot issue a press release and create a barrel of oil, a ton of copper, or an ounce of mined silver instantly. But here's the cliffhanger nobody wants to talk about. If peace headlines improve, metals could still rise. If war headlines worsen, metals could still fall. Why? Because headlines are not the engine. Positioning, liquidity, real rates, debt confidence, and investor psychology are the engine. Headlines just grab the steering wheel for a few minutes. So if silver is going to make a serious run, I would watch three things. First, does silver hold above the areas that recently turned from panic zones into support zones? Second, Does gold remain firm while silver gains faster? Third, do bonds continue sending stress signals even while stocks look calm? If those three things line up, then the silver story becomes much more interesting. But if silver falls back hard, loses momentum, and gold stops confirming the move, then the giant targets should be put back on the shelf. Not thrown away forever, just shelved until the market earns them again. That's the part many people miss. You don't have to marry a forecast. You can respect it, study it, and still demand confirmation. So, could silver reach $300 to $500 this summer? It is possible in the sense that markets can do wild things when a crowded world gets repriced. But as a base case, it is extremely aggressive. A more reasonable view is that silver has already changed character, and the next major confirmation would be whether it can reclaim higher ground and hold it without immediately giving everything back. If it does, the crowd will notice. And when the crowd notices silver late, it usually doesn't walk in quietly. It runs, then panics, then calls it obvious afterward. So don't get hypnotized by the biggest number. Watch the behavior. Watch the recoveries. Watch whether bad news stops pushing silver down. Watch whether good news stops helping stocks as much. Watch whether bonds keep acting tired. That is where the real story will show up. And remember, this is not about cheering for a broken system. You don't want chaos just because you own metals. The better outcome is repricing, not collapse. A functioning market that finally values scarce assets properly is very different from a broken market where nobody knows what anything is worth. So stay sharp, stay patient, and don't let either hype or fear make the decision for you. Everything we covered here is for education and market discussion only. I'm not telling you what to buy, sell, or hold. Use this as a framework, check your own risk, and make sure any move you make fits your plan, not somebody else's prediction.